Hey, this is Chris from StockSpot, and in this video, I'm going to be talking about returns. Returns is one of the topics that we get a lot of questions from clients about. So this video, I'm going to be covering how do we calculate different types of returns? When is it appropriate to use one type of return over another when you're thinking about your performance? Where you can find different types of returns in the StockSpot dashboard, and also some tricks and tips to think about when looking at returns more generally. So starting off with the different types of returns. So we actually show 3 different types of returns at StockSpot. The first one I'm going to be talking about is just a time-weighted return. Now, this is probably the most commonly displayed return in the investment world, and that's because most fund managers use time-weighted returns to show their performance, to allow you to compare their performance to the performance of an index or another fund manager. A time-weighted return basically assumes that you invested a single sum of money on the first day and then looks at how that particular investment, whether it was a portfolio or an ETF or another asset, has performed over time. So it assumes a single investment on a single day, and so it gives you a really nice way of comparison, and that's where time-weighted returns come in really handy when you're comparing returns. So on the StockSpot website, on the performance page where we show the historical returns of the StockSpot portfolios, or even in the StockSpot newsletter where we talk about performance, that's where we actually show time-weighted returns, because it allows you to benchmark the performance versus other types of investments out there. However, for an individual investing, time-weighted returns aren't very useful because it doesn't actually show the return that you earned. And that's where we get to the next type of return, which is looking at a total return. So a total return, unlike the time-weighted return, which is a generic return, the total return is your own personal return over a period of time, and simply looks at what profit you've made, a combination of income and dividends, versus how much you've invested as a percentage. So the benefit is you actually see your return personally, but one of the downsides of time-weighted returns is it actually looks at your final balance when looking at what percentage return you made, which means if you're someone that's been regularly investing, dollar cost averaging by drip feeding money into the market, a total return will actually understate your percentage return because it will be looking at the profit you made versus your final figure, which may be a lot larger than your average figure over that time or your starting figure. And that's where we get to the third way of showing performance, which is a money-weighted return. Now, a money-weighted return is a little bit more complicated than a total return because it looks at every single discrete investment you made. So every time you dollar cost averaged in or you made sales, and then works out across your whole time of investing, what's the average return you made on all of those incremental investments. So you can think about it like a weighted average return across all of the money that went in and all of the money that came out of your portfolio. And it really gives you an accurate figure to basically think about what your return was if every amount of money had been invested in a bank account instead at the time that those investments were made. So it's a more complicated calculation, but it gives you a really accurate way of understanding your actual performance. And we take that time-weighted return to another level, which is then we annualize that time-weighted return. So then that considers what is your time-weighted return on average across your time with StockSpot. So there are 3 different ways that you can look at return. What's more appropriate will depend on what you're actually looking to do. Are you looking at your own performance? Are you trying to understand how you returned in your portfolio versus putting that money in the bank? Or are you just looking at the average returns of that portfolio as a whole over time? And there can be different reasons why you might want to use one over the other. In terms of some tips or tricks that you need to think about more generally when thinking about returns, the first one I'd say, and I see a lot of people forget this one when thinking about returns, is make sure you're including dividends. So for Australian investors particularly, dividends are a particularly large part of your overall returns. And if you're ignoring dividends when calculating your overall returns, you're probably really understating your performance. So make sure you've captured your dividends. We do that in the StockSpot dashboard by cumulatively calculating returns using all of the dividends you've earned in the past. But if you're managing your own portfolio, you'll want to capture all of those dividends when managing the performance calculations. The second thing I'd say is that the timing of your investing does have a big impact on your performance, but that's really a decision that's made by you and not the investment product that you're buying. And so you should be separating how is the actual performance of the product I'm buying versus my own decisions about when to buy and sell that investment, because they're actually totally different. And if you're judging an investment product, it's probably not fair to look at the total return or the money weighted return, because that's driven by when you decided to buy and sell, but actually looking at the overall return or the the time-weighted return is the better way of looking at an overall performance of an investment. And the final tip I would say is you always have to include fees when it comes to calculating performance. I do see different products out there where the fees aren't actually taken from the investment product, they're actually taken from a separate bank account, and then the calculations of performance ignore that fee when it comes to calculating the total returns. It's really important wherever you're calculating returns, not only to look at the income and the dividends and the capital growth you're earning, but any costs you had to incur to actually achieve that performance. And so really making sure you're capturing fees in your performance calculations is critical as well. We do it on the performance table within the StockSpot dashboards, make sure it's an after costs performance figure that we're calculating. But if you're managing your own investments or using another investment app, really look carefully at whether the fees are being included in the performance calculation. Particularly with some investment apps that take a fixed dollar amount out each month where your investment balance might be quite small, then that actually might have a huge impact on your performance if that number's actually getting calculated. And that's my summary of the different ways that performance can be calculated, when to consider using one over the other, and a few little tricks and tips to be conscious of when actually calculating your investment returns.